Here's an example from Chapter 4, when an organization changes their principle from one acceptable principle to another. So here, you've got the download to the actual problem, but the company began operations in 2017 and it adopted weighted average pricing for inventory. So in 2017, in accordance with the other companies in its industry, it changed its inventory pricing to FIFO. And here's the pre-tax information. Now remember, this is pre-tax information. And then you told the tax rate's 35%. So the first question is, what is the net income assuming that tax rate? Well, if you just start with your income before tax of $460,000, and then you calculate your tax at your 35% of that, which is $161,000, you end up with net income of $299,000. The second part of the question says compute the cumulative effect of the change in accounting principle from weighted average to FIFO. There's a couple things that we need to know first. So in a simple set, you go ahead and you've got your year, then you have your weighted average, your FIFO, your difference, and then we're going to talk about the tax and the effect. But I've already got the data here, so I may as well go ahead and use it. The difference between FIFO and weighted average for 2015 is $25,000. And the difference in 2016 is $30,000. So that's a total of $55,000. If I was to formally submit that, I would go ahead and put it here, 2015, 2016, etc., and I'd have this all in here. But I'm just going ahead and giving the total because that's really all that I've asked for. I've been asked for the $55,000. We know that the tax rate's 35%. So the tax rate is $19,250. Well, the net effect, if I've got an increase in income of $55,000 and then I have to pay an additional tax of $19,250, the net effect of that change would be an increase in my retained earnings of $35,750. So if I had done FIFO all along, retained earnings would be that much higher. The third part asks, show comparative income statements from beginning with income before tax as presented on the 2017 income statement. So now we need to make sure everything shows up so someone with the prior income statement looks at it and they don't say, wait a second, you use different numbers before, what's happening? So it's just a matter of clarifying everything, and this is where organization really helps. So we're going to have the years 2017, 2016, and 2015 all reported, and we're going to talk about our income before tax using the numbers we're given. We were given $460,000, $420,000, and $395,000. Then we go ahead and calculate your tax at 35% and come out with what's going to be your net income. So in 2017 at the 460, this is the part A of the problem we've already done. Tax is $161,000, so net income is $299,000. In 2016, tax would have been $147,000. So net income is $273,000. And in 2015, tax is $138,250. So net income is $256,750. and that's reporting a change of accounting principle. The second problem deals with comprehensive income. You've got this information as well, so I'm just going to kind of take this image just so we have it on our example, but I'm going to make it smaller so that way I can fit other information here. And we're going to do a basic income statement, but there's certain parts that I really want to make sure that you understand. What I've done is I've gone ahead and I've put the information from a statement of comprehensive income on the right. It helps. My writing's not so great, but it also, it's so much easier if you end up doing this in an Excel file. So all I'm doing is I'm taking information. We know how examples start. Now note this is net sales. So it's actually sales minus sales returns and allowances minus sales discounts. But we're going to go ahead and we're going to take the information from sales revenue and bring that up as net sales. Following that, we have cost of goods sold. That's another item that's just gone ahead and given to us. So we're okay there. Sales minus cost of goods sold gives us gross profit. That's a term that you need to know as well as the calculations. It's a simple calculation, but you just need to pay attention to it. Selling expenses, sometimes they're given to you in a list and you have to add them up. But for our example here, we just know that selling expenses are $300,000 and administrative expenses are $240,000. Now there's a nice thing about accounting underlines. When we go ahead and make an accounting underline, it means we're having a total. So I could have put the total of selling and administrative right here, or I could put it on the line below. Either way would be absolutely acceptable. But they total to $540, and when I take that out of cost of goods sold, I end up with $310,000. Now what we're ending up doing is we're coming up to continuing operations and discontinuing operations. This is kind of our major operations. That's our income from operations. And now we have kind of those other expenses that come out that aren't great major expenses for us, but they are majorly consistent. They're not a material amount of income every year, but they do provide things consistently. We had a sale on plant assets that we had a gain. So we depreciated it, and our net book value, which is sales or cost minus accumulated depreciation, was higher than the amount we sold it for. So that was good. And then we had rent revenue. That could be an extra income. It's not really what our company does, but maybe we had the space. We're not ready to use it yet. And then we had a loss on impairment. And so that amount was given to us. That was given to us actually in the earlier pieces of information. And that's there. We end up totaling it, and they come to $75,000. So 310 minus the 75,000, or excuse me, the loss was a subtraction, but the other two were gains. So it ends up to be a positive 75,000. So when you go ahead and you add 310 to the 75,000, you end up with income before income tax of $310,000. 35%, or sorry, the number was given to us as income from continuing operations. Normally you would go ahead and you would calculate it at each part, and that's kind of where we're going to talk about net of tax in a minute. So that's given to us. So our income from continuing operations is $266,000. Well, if we've got income from continuing operations, the next logical step is, well, what was discontinued? And there's two parts to the discontinued. One is on the sale of assets and one is on the operations. So we were told the operations had a loss of $75,000. And then when we don't have the information on the assets, but we would put it right here as well. We were told that the income tax comes in here as well from that same loss. So what we end up doing is we end up showing what happens net of tax for discontinued loss. And net of tax is very key because this number right here, income from continuing operations, includes taxes. So individuals who are interested in looking at a company know what that company's income, including tax, would look like for their normal operations every year. So everything after that point has to be net of tax to be consistent. So we end up with net income or loss of $216,000. That's the amount that kind of comes in for our income. But remember, we talked about those other comprehensive things. We had this unrealized holding gain that came in. So we've got to make sure we include that and disclose that for the users. So the 216 plus the 15 unrealized holding gain gives us comprehensive income of $231,500. And that's kind of our income statement, with the exception that we need to have earnings per share. And earnings per share has to be listed for every major item in the income statement. So a major item is continuing operations and discontinuing operations. So since we were told we had 100,000 shares, weighted average shares, what you end up having is you end up having net income minus the amount that's obligated to be for the preferred shares. So if you have to pay your preferred shareholders, you have to take that amount out, and you're going to divide that by the weighted average number of shares to get your earnings per share. So what we end up having is $266 divided by 100,000 is $2.66. 49,500 from our discontinued operations, that's a loss. 49.5 rounds up to 50 cents. And net income is right here again. Now remember, this part here, the comprehensive income, isn't the total income that we're dealing with. That adds those other items that aren't really income expenses or income revenue items. So we've got to go with our 216. And so this 216,500, just like this, becomes 217 rounds up. And that becomes our earnings per share. The final statement is a retained earnings statement. So we've been told our retained earnings at the beginning is $600,000. We're going to add our net income. Again, this is the 216,500, not the comprehensive income. So the income available for our owners is $816,500. We were told that there was going to be a dividend, and they were declared. We used the kind of the accrual idea that we've already declared them, so we're obligated to pay them, of $150,000. That leaves ending retained earnings at $666,500, and that's the illustration of your comprehensive income problem. Please let me know if you've got any questions.